Crypto made you rich, or at least that's what your portfolio told you at 2 in the morning on a Tuesday. But the IRS, they've been watching every single swap, every meme coin flip, and every just moving funds between wallets moment you thought was invisible. Here's what most people don't realize. The United States government doesn't see crypto as currency, it sees it as property, just like a house or a stock. That one classification changes everything, because it means every single trade you make is a potential taxable event, full stop. So when you swapped Ethereum for Solana back in 2021, riding that wave of pure euphoria, you technically triggered a capital gains event even though you never touched a dollar. The market was screaming, "We're all gonna make it," and the tax code was quietly whispering, "Not without receipts, you're not." The catalyst here isn't greed or ignorance, it's complexity dressed up as simplicity. Crypto was sold to the world as financial freedom, decentralized and borderless. But the tax infrastructure surrounding it is anything but free or simple. Think of it like this. You thought you were playing Monopoly, passing go and collecting $200, but the government handed you a rule book written in a mix of tax law, securities, regulation, and sheer bureaucratic stubbornness. The gap between the libertarian dream of crypto and the reality of Schedule D filings is wide enough to drive a Lamborghini through, and yes, you'd owe taxes on that Lambo too if you bought it with Bitcoin. Remember 2021, when everyone had a crypto portfolio and a financial guru in their Instagram DMs? The mood was electric, the memes were flowing, and the idea of owing taxes felt like a problem for future you. Well, surprise, future you has arrived and brought a Form 1099 DA. Now that same community is quieter. The influencers have pivoted to AI, and the tax bills are starting to land like a plot twist nobody voted for. Historically, every asset class that explodes in popularity eventually meets its regulatory reckoning. Tulips, railroads, .com stocks, and now digital tokens are all reading from the same script. The difference with crypto is that the volatility is so extreme that you can owe taxes on gains that no longer exist. A phenomenon so cruel it has its own name, phantom income. Here's a real scenario that'll make your stomach hurt. Imagine you turned $1,000 into $50,000 in 2021, then watched it fall back to $8,000 by the time April rolled around. You still owe taxes on that $49,000 gain, even though the money is essentially gone. And that's not a glitch in the system. That's the system working exactly as designed. Now let's kill the biggest misconception before it kills your bank account. Holding crypto in a wallet does not mean you're invisible to the IRS. Exchanges are legally required to report your activity. Blockchain transactions are permanently and publicly recorded, and the IRS has been contracting analytics firms to trace wallets since at least 2015. The practical lesson history keeps teaching us is this: keep records like your financial life depends on it, because it literally does. Use crypto tax software. Document every trade with dates and cost basis, and treat tax planning as part of your investment strategy, not an afterthought you Google in March. The disciplined trader isn't the one who calls every top and bottom, it's the one who accounts for taxes before calculating profit and sizes their positions, knowing that the government is a silent, mandatory partner in every trade. Unemotional strategy means acknowledging that a 60% gain with a 30% tax bill is not the same as a 60% gain, and your process needs to reflect that math. At the philosophical level, the traders who survive long enough to build real wealth are the ones who respect the rules of every arena they play in, including the tax code. Discipline, consistent record keeping, and honest accounting aren't just good habits, they're the unsexy foundation that separates the people who build wealth from the people who just temporarily hold it. And honestly, being prepared for any outcome, a bull run, a crash, or an audit, is its own form of freedom. When your records are clean, your strategy is documented, and your tax liability is already budgeted for, you can actually sleep at night instead of refreshing CoinGecko at 3 in the morning. The crypto space rewards boldness, but the tax code rewards preparation. And the beautiful irony is that the boring, organized investor almost always outlasts the reckless moonshot gambler. You don't have to be the smartest trader in the room, you just have to be the one who's still in the game after tax season. Whether you're just getting started or trying to untangle a few years of trades, check out our links in the description below. We can help you with real estate investing, home contracting work, and finding the right lenders to build your financial foundation the right way.